Hey guys, Eddie Speed. So, how is the virus and the quarantine and real estate investors and note investors, how is that all going to be affected? Well, if I had the perfect answer, I would have a crystal ball. And while I don't have a crystal ball, I do have a rear view mirror. So let me tell you what I do know. What I do know at the moment is that we are definitely heading for a credit crunch. And we haven't seen one of those literally since the debacle of 2008. In my career, in my 40-year career, I've only seen 5 in the past. So it's very interesting that it formed into this, and there's some reasons for it. So I want to talk about what they are and signs to look for. Now, warehouse lenders, the lenders that loan money to banks, they ended up with a lot of their clients, the banks that make mortgages, they ended up with a lot of loans that they thought they were lending money that were going to get sold. And those loans have got stuck on the warehouse lines and they're not selling. Specifically, they're hard money loans and they're non-QM loans. Now, if you're a lender and you loan money for FHA, VA, Fannie, Freddie, then you're selling those loans into a conduit, which ultimately end up usually in a bond offering, okay? So the concern there is there's a provision when you're selling those loans, those mortgage lenders that make loans, there's a provision that says if something happens to this loan, it's not what our underwriting guidelines were, or if something happens to it immediately after you sell it, like in the first month or so, it's called an agency buyback. And then that loan is bought back. Now remember, they probably sold this loan for 102 cents on the dollar. Now all of a sudden it's probably worth 70, 80, 90 cents on the dollar. The market right now hasn't shrunk to 70 cents. But by the way, there's not many of these, they call them scratch and dent loans. There's not many of these loans selling in the market. So if you're following the money here, you're starting to see where a mortgage lender is having trouble getting money from the bank that loans him money, the warehouse facility, okay? And they've gotten really stingy in the credit to the point that about 30% of the people that could have gotten a mortgage in the middle of February can't get a mortgage today. Oh, something worse. You know these 4.5 million loans that are government-supported loans, the FHA, VA, Fannie Mae, Freddie Mac, you know those loans we've been talking about? Well, they've reached out to them and says, look, if you can't make your payments, we will allow you to do a forbearance agreement. Now, what is a forbearance agreement? A forbearance agreement simply says that, Mr. Customer, you take off these months and you're going to start back in 4 months later. Well, you're like, well, that's really cool. The government did that. Problem is, the government gave them stimulus money, but they didn't make their mortgage payment, right? But the loan servicers that sold these loans to the bonds that were created after they take these big group of loans and put them into a bond offering, the mortgage servicers are obligated to make those payments. Now think about this for a minute. The mortgage servicing industry is writing a check on 4.5 million loans to the bondholders that they're not getting a payment for. In fact, in the last few days, the government came in and funded almost $200 billion and was the biggest investor in a bond of these mortgage-backed loans, these government-sponsored mortgage-backed loans. In other words, they came in and wrote the check because the marketplace, Wall Street, wouldn't buy the bonds. Well, would they buy the bonds? I don't know. the government all of a sudden wrote a check and bought them, and why are they in that business? In fact, they haven't been that active doing that since 2009. Okay, so all this is sort of buried in the news. I don't know that CNN is doing it or even Fox is doing it. It's definitely in the news. Definitely be glad to share with you some specific details of it. But these are the facts that are going on behind the scene. So how many realtors, how many wholesalers, how many people involved in real estate understand this underlying essential bomb in the market that is happening? When you see people say, oh no, I don't think real estate's been affected at all. Well, let me just generally tell you this. There is still a place for a perfect loan. If you have a perfect loan with a perfect buyer, they can still get a mortgage. Certainly can. But anything that is less than perfect, and that is hard money loans, rental property loans, people with any kind of a glitch or any kind of a less than 700 credit score, there is a underlying issue that has come into the market. In other words, there is a quickly growing scarcity to conventional mortgage financing. Bad news or good news? Bad news or good news? Well, who are you and what do you do? Well, it's bad news for you if you don't have a solution. It's great news for you if you understand creative financing, because creative financing in these 5 prior credit crunches that I've lived through since 1980, 5 different times I've seen this happen before. Creative financing came to the rescue. I hope you're seeing the opportunity. I hope you're getting a vision of the market and where it's going. I hope my simple explanation of where the traditional mortgage industry is, helps you understand that we make the most money as entrepreneurs when we fill a void that the conventional world can't fill. Entrepreneurs solve problems, and when they solve problems, it produces opportunities for us that other people can't fill. Mark this one on the wall. This is going to be a big one. This is going to be a big one. Seller financing fills the gap that conventional lending doesn't. Hope this is helpful to you. See you later.